All right, guys. The first carrier on the list will be Mutual of Omaha. Well, not in most cases, Mutual of Omaha is our go-to carrier. But as of recently, Americo has been our go-to carrier because of the ease of their application, as well as their underwriting has been shown to be slightly less stringent and strict compared to Mutual of Omaha. Now it's case by case, so don't assume, if a client gets declined with Mutual of Omaha, they're going to get approved with Americo, because that's not the case. There's been plenty of times where I've had a client get declined with Americo and then get approved with Mutual of Omaha, or get approved with Mutual of Omaha and get declined with Americo. So it's 50-50. But as of recently, with Americo's new drop of their IUL product, a lot of us agents have been using their system and their IUL because their application is so easy. But Mutual of Omaha has been our go-to carrier first and foremost in most cases, which is why I want to make a video about them first, as well as their product is very easy to break down and explain in regards to showing cash value numbers and so forth for the client. And I want to teach you agents out there how to really do that at a very high level. So first, typically what I do when I'm talking to clients is, I'll give them a quote to figure out, how much coverage they can get specifically for an IUL policy. So we'll start there first. This is our fluentquotes.com website. It has all our carriers and has quick links to access these quotes. So if we go to Mutual of Omaha and we go to the Index Universal Life Express or the IULE product, and let's say the client is 50 years old, they're in Arizona, and they want $100,000 of coverage, and they're non-smoker. Hit calculate, boom. So for this client, the monthly premium will be $134 per month. And when I'm talking to clients, I typically break down this price point in two ways. One, I say this is going to be the required amount every month for the life of the policy, because these IUL policies are permanent coverage, meaning it is going to protect you until age 121. It's also day one coverage for the client. So God forbid if they got a policy today and died tomorrow, the policy will pay out $100,000 to the beneficiary. The second point I bring to the table and I explain to the client is this is also referred to as your minimum premium. What that means for the client is that's the required amount every month for the life of the policy at a minimum point. So like you're at bare minimum, you're required to pay $134.36 per month. And the reason I break it down like that, because the IUL in a sense is also an investment vehicle as well, plus a life insurance policy. So remember, let's say hypothetically the client does get approved at $134 per month, and then they say next month they actually want to put in additional funds more than the $134. They can do that, and we call that overfunding the policy. The client has the option to put in additional funds into this IUL to take advantage of the cash value and the compound interest that's associated with this policy. And so I'm about to show you guys, when you're talking to clients, how to illustrate and how to show you those cash value numbers with an illustration. So once I've kind of showed the client, this is your minimum premium, this is how much it's going to be per month, then I will share my screen with a software called Crankwheel, which is right here, just to show you guys. And then I'll share my screen, and then we'll go over the illustration numbers. So in order to go over the illustration and cash value numbers for a client for Mutual of Omaha, we use a software called Winflex. So first and foremost, make sure if you've not registered for Winflex, you register for Winflex. The process is very simple. Click on it here, and then you just put in your credentials and your information, and then you'll have an account with Mutual of Omaha. So if we go back and log into Winflex, okay, well, 1, 2, 3, 4. Oh, wow. Okay. If I can remember my password. 1, 2, 3. Oh, damn. All right. Okay, I'm going to pause the video and figure out what my password is. Okay, I figured out my password and I've logged in. So Once you log in, this is what your what your Winflex register or Winflex account, will look like. And from here, you want to go to illustrations. And then you want to start a new case, Mutual of Omaha, and you want to go to the Index Universal Life Express product. This is the IULE. Click here. And then we will put in the client's information. So remember, this client was 50 years old. Client. And non-smoker. You don't have to worry about putting the date of birth if you know the client's age. And then they were in Arizona. And remember, you want to go to solve for, easy solve. I'll break down these other ones here in a second. But we were doing a death benefit of $100,000. So you want to change the premium to $100,000. It's going to solve for how much $100,000 would run you. If you wanted to solve it the other way, for example, if the client was like, hey, I can only afford $200 per month, you put in $200 right here, and then it will actually solve for how much coverage they can get. But right now, we're just doing $100,000 of coverage. Disbursements keep the same. Index strategy, we keep this the same at 100% for the S&P 500 1-year account. Policy options, premium mode. So BSP is just, in layman's terms, it just means monthly payments. The client can do quarterly, semi-annual, annual, or monthly payments. In most cases, we would do monthly payments. And then everything else down here is the same. Riders, you can add riders in here if you would like. Reports, keep this the same. Agent information, make sure you put your agent information in here. Otherwise, when you go to calculate, it's going to error. So it's required that you put in your agent information all the way to completion so you can submit this illustration. I have my information saved. So done. And then hit calculate. And it's calculating. All right. And then you have the information here. So death benefit $100,000, the annual premium of $16.12, and then all we really care about is this PDF right here. So we're going to click this PDF here, and then it's about a 37-page document. On the second page, it has the basic information, monthly premium, $100,000. If you look closely, $134.36 was the same premium that we calculated over here. So the two should match. All right. So if we scroll all the way down to about page 27. This is really the most important page on this illustration. And this is what you should be going over with the client. So if we look closely, we have a death benefit of $100,000, male, age 50, standard non-tobacco, monthly premium of $134.36. And then we have these different illustrated rates. We have guaranteed at 0%, alternate scale non-guaranteed at 3.75%, and then this non-guaranteed at 5.92%. All we care about is this non-guaranteed illustrated rate at 5.92%. And you're basically going to be quoting the client on the cash value numbers based on the non-guaranteed. And I'll break down what exactly that means here in a second. But first, if we look at the non-guaranteed column, there's three different things. There's three different sets of numbers in here. The accumulation value, the surrender value, and the death benefit. We only care about the surrender value in regards to cash value. The surrender value is how much money can the client pull out at any given time, tax-free and penalty-free. So if we look closely, the client can't pull out any funds on this policy until year 4, and it's only $424. And so you have to be mindful and let the client know that this is more of a long-term investment. You can borrow from it starting in year 4, but ideally you do want to let this, accumulate and build cash value over the years. And the main reason, if the client asks, like, hey, why can't I borrow any money in years 1, 2, or 3? The main reason for that is because, remember, this is also a life insurance policy as well. So those first couple years, the client is going to be paying for the cost of insurance as well. So the cost of insurance basically eats up the cash value those first couple years, and then they don't really start to yield any results until year 4. If the client's like, hey, agent, I want to be able to borrow against my policy sooner rather than later. I don't want to wait till year 4. Is there anything I can do to accelerate this process? And yes, there is a way. Remember, you can overfund this policy, meaning you can put in additional funds. So, for example, if the client says, hey, instead of funding my policy at $134 per month, if I do $250 per month, will that allow me to borrow against my policy sooner? And it absolutely will. Basically, they might be able to borrow in year 1 or year 2, but they take care of the cost of insurance at an accelerated rate because now they're paying more than the minimum premium of $134. So it allows them to borrow against the policy sooner rather than later. But you guys have to be very mindful of a couple numbers. So if we scroll down to the bottom and we look on page 31, you guys need to be very mindful of these numbers right here. So the biggest number you need to be mindful of is this TAMRA 7 pay. The TAMRA 7 pay is how much money the client can put into this policy per year, every year in the first 7 years, meaning in year 1, they can put $8,075. In year 2, they can put $8,075. Year 3, year 4, year 5, year 6, year 7. And then after year 7, the most they can put into the policy per year is this 2558 number, this guideline maximum level. But you need to make sure the client is very mindful of this TAMRA 7 pay number because this is the most they can put in per year. If they go above this number, the policy will become a MEC, or a modified endowment contract. What that means to the client is now their policy will be taxed by the government. We do not want that. The whole purpose of these IUL policies is to be able to borrow against your funds tax-free and penalty-free. So they want to be mindful of this number and stay below this number. So as long as the client stays under this $8,750 threshold, they will not be taxed on the policy. So all this means is they can put up to roughly $8,000 every year in this policy. Right now, if you look at the premium for this policy, it's $134 per month. That's roughly $1,612 per year. That means specifically for this policy, this client can put in, if you do $8,075 minus this $1,612 number, that's how much additional funding they can put into this policy. Now, if they say, hey, Mr. or Mrs. Agent, I want to put in more than $8,000 per year, is there any way to get around this? And yes, there is. If you increase the death benefit on this policy, this number goes up. This TAMRA 7 pay directly correlates with the amount of money the client can put into this policy. So if they take their death benefit from $100,000 to $200,000, this TAMRA 7 pay will now go to like $16,000, and it will allow them to put in additional funds. Another number you guys need to be mindful of is this guideline single premium number. This guideline single premium number at $36,891, this is the most amount of money the client can put into their policy in the first 14 years as a cumulative number, meaning over 14 years, they can only put in $36,891. That is a total number. That is not per year, every year. That is total over 14 years. It's different from the TAMRA 7 pay. The TAMRA 7 pay is the most amount of money you can put in per year, meaning up to $8,000 every year, essentially. But this guideline single premium number is how much you can put in over the first 14 years. So, for example, if the client were to put in $8,075 year 1, year 2, year 3, year 4, and year 5, if we do $8,075 times 5, that equals $40,375. So technically, the client would get capped off in year 4 because they would hit this $36,000 number in year 4. So meaning after year 4, if the client were to put in $8,075 every year, they wouldn't be able to fund this policy anymore until year 14 of the policy. So be very mindful that this number is how much money they can put in the first 14 years, and this TAM or 7 pay is how much they can put in per year. Now, if we go back up here to these cash value numbers and we break down the differences between guaranteed, alternate scale non-guaranteed, and non-guaranteed, let me break down what exactly that means. So remember, the IUL, or the Index Universal Life Policy, is a part of the S&P 500, which is an index fund. It's kind of invested into the stock market, but not really. So an index fund just means you can reap the benefits of when the market is up, your money's up. But when the market is down, you have a 0% floor. So your money is protected from any asset or any asset loss because it's in an index fund, but you are capped off at typically 10% with the stock market. So if the stock market is up 20% for the year, the most your IUL policy can be up is 10%. But the biggest benefit about an IUL, and I always highlight this to clients, is if the market is negative or volatile for the year, you have a 0% floor, meaning you don't lose a penny on this policy. So this 5.92%, this non-guaranteed illustrated interest rate, this comes from, on average, how these IUL policies are performed in the past 25 years. This is just a projection based on the past 25 years. So that's why it's quote unquote non-guaranteed, because remember, the market is volatile. I don't have a crystal ball. You don't have a crystal ball. The client doesn't have a crystal ball. No one knows what the market is going to do. So we can't guarantee them 5.92% every year. It's just a projected amount based on the last 25 years. But it's more than likely going to perform at this 5.92%, if not better. So that's why we go based on these numbers, because realistically, this is what the cash value numbers are going to look like for the client. Now, if you look at this guaranteed interest rate over here at 0%, one thing I want you guys to be very mindful of is, if we look at the surrender value numbers, look at the non-guaranteed column. In year 5, the client has $1,671 to pull out tax-free. In year 5 over here in the guaranteed column, it's still sitting at 0. The reason for that is because in this guaranteed column, they're getting 0% interest on their money. The reason the carriers have this 0% guaranteed column is because this is what it would look like for the policy if the market was negative every year, year after year, consistently. Because think about it. If the market is negative for, let's say, this year, the client's going to get 0% on their money. If the market is negative next year, the client's going to get 0% on their money again, and so forth. So this guaranteed column, it's guaranteed because we can guarantee the client won't lose any money. So basically, if the market was negative every year, year after year, they wouldn't have any cash value until about what year is this? Until year 9. If the market was negative every year consistently. But let me tell you guys something. The market has never been consistently negative more than like 2 years in a row or 3 years in a row. And that was in like 1930. You can pull up an S&P 500 historical like data chart, and it will show you how the market has performed in the past century, and the market has never been consistently negative for more than 3 years. So this will never happen. But in case the client does ask, you can break it down to them like, hey, this is what happens if the market is negative every year consistently. And if you look closely, this policy actually lapses in year 20 in the guaranteed column, because they're not building any cash value. So ultimately, the cost of insurance eats away from this because they're not getting any additional interest on this policy. So if the market were negative 20 years in a row, this policy will lapse after 20 years. But like I told you, that will never happen. If the market was negative 20 years in a row, I'm gonna be honest, America would not be around. We would have much bigger fish to fry than IULs. And then this alternate scale non-guaranteed column, this is basically just like a nice midpoint between the non-guaranteed and the guaranteed. I really never talk about it much. I only highlight the non-guaranteed and the guaranteed column if the client asks. And really, I just talk about the non-guaranteed because realistically, this is what the market is going to look like more than likely. And if I'm being frank, this 5.92% number it's a conservative number. The illustration rates right now are sitting at 7.71%. So technically, these surrender value numbers, these cash value numbers right here, would actually look a little bit better for this client because the illustration rate is a little bit higher than this. But I always like to um under promise and over deliver. So I'll let the client know, hey, conservatively, these are what the numbers are going to look like. So just so you guys know. Now, back to the in regards to overfunding these policies. So if the client says, hey, I want to put in, more than $134 per month, how do I go about doing that? Because the client's main goal is to, let's say, build extra cash value. So if we go back to our illustration to Winflex and we go back into sample client, there are two ways to create illustrations for the IULE, or the Index Universal Life Express. There's Easy Solve. Easy Solve basically either calculates the face amount or it calculates how much the client has to pay per month for the policy. So it spits out all the numbers for you. That's why it's referred to as Easy Solve. And then the other way to create an illustration is called No Solve. No Solve allows you to customize the face amount and the monthly premium simultaneously. So for example, in this scenario, the client says, hey, I want to build better cash value at an accelerated rate. Let me overfund my policy. I'll say, okay, client, let's do that. So we'll keep the death benefit at $100,000. And real quick, I'm actually going to save this PDF so we can compare apples to apples. So, boom. All right. So $100,000 is the face amount, and let's change the monthly premium to $250 per month. So monthly premium is $250 per month. Cool. We're going to hit calculate. All right. And so there's actually an error on here, and it says guideline violation in policy year 13. And I'm going to show you what exactly this means and why it's erroring. But if we go into the illustration real quick, just to answer my first point, and we go down to the cash value numbers. Where's it at? Page 27-ish. So right here. And then if we compare this to the first Easy Solve illustration I made, which was at $134 per month right here. Let's zoom in. Remember, the client couldn't pull out any money until year 4 in this policy when they were doing the bare minimum of $134. Now, the client says, hey, I want to overfund my policy and put in additional funds. So now the monthly premium is $250. The death benefit is the same at $100,000. But guess what? Look at the cash value numbers now. The client can actually borrow money in year 2 now because they're now overfunding their policy at $250 per month. So if the client is ever interested in building better cash value for their policy, you can just overfund it with additional premiums. There's actually 2 ways for a client to build better cash value. Real quick, I'm going to touch on that briefly. The first way is the way I just did it, keeping the death benefit at the exact same of $100,000 and increasing the premium to something more than the minimum premium. In this case, we increased it to $250. But there's also another way. If the client says, hey, I don't really care about my death benefit at $100,000. I just want better cash value. What you can do is, if they say, I can only afford $134 per month, you can actually decrease the death benefit, keep the premium the same, and then the cash value goes up. Because now, when you decrease the death benefit, let's say we took the death benefit from $100,000 to $50,000. The cost of insurance is much lower now. So they're paying for less cost of insurance, and more of their premium is going towards the cash value. So for example, if I go back, I'm going to save this illustration too real quick. If I go back to this illustration and I change the death benefit to $50,000, and then I change the premium to match $134, let's just say We'll just say 134 for easy math. 134. And we hit calculate. And then we hit calculate. Once again, there's another error here. This time it says guideline violation in policy year 12, which I'll break down what that means here in a second. But if we go down to the cash value numbers, all right. So now look closely. Death benefit is $50,000. Premium is $134. But guess what? Look at the cash value numbers on this illustration now. Even though the client is only putting 134, just like in this illustration, they're putting in 134, they can borrow in year 2 now. And the reason for this is because we decreased the death benefit from $100,000 to $50,000. So now the client is building cash value at a more accelerated rate because the cost of insurance is much lower. So there's 2 ways to go about increasing cash value for the client. One, you can keep the death benefit the exact same and just overfund the policy with additional funds with higher premiums. Or 2, you can keep the premium the same and lower the cost of insurance, and now they'll build better cash value. So I want you guys to be very mindful of that, because in most cases, a lot of clients, they want better cash value. And a lot of agents, unfortunately, do not know how to create illustrations to maximize cash value. This is how you undoubtedly maximize cash value for these IUL illustrations, by either overfunding the policy with additional funds or lowering the death benefit and matching the premium at what the client can afford to be able to maximize this cash value. Now, to answer or to kind of touch base on why this is erroring. So it says guideline violation in policy year 12. And specifically, it's talking about this policy I just created right here. If we look closely over here, every year the client is putting in roughly $1,608 per year, which is $134 monthly. Every year. And then in year 12, it cuts them off at $1,337, and then year 13 they can't put anything, year 14 they can't put anything, and then starting in year 15 they can start funding the policy again. The reason for this is because, remember, in the first 14 years the client can only put in this guideline single premium number. So this $19,000 number right here got hit in year 12. So the thing I love about Mutual of Omaha is it makes you whole with the illustration, meaning because the client technically can't put in more than $19,000 in the first 14 years, it cut the client off from putting in any additional funds after year 12, because that $19,000 threshold got hit in year 12. And then it cuts them off from putting any funds in again until year 15. So Mutual of Omaha will always make you whole, but you have to be mindful of that because it will tell you there's an error. So as long as you know what the error is, you'll understand that, hey, okay, the client can't put in any more funds until year 14. Cool, I understand that. So if you're like, hey, how do I get past this error, or what do I do to resolve this error? Remember, you just increase your death benefit, because the death benefit directly correlates with these numbers down here. So the higher your death benefit is, the higher these numbers become. So for example, if I go back and change this death benefit from 50,000 to 75,000, and we keep the premium at 134, I guarantee you there will not be an error. I bet $10,000 on it. There will not be an error now. Excuse me. Look at that. No error, because if you look closely, also just to show you guys a quick little trick, on this screen, if you hit more and go to policy information, it brings up all those numbers I was talking about. So the MEC premium limit is the same thing as the Tamara 7 pay. So the Tamara 7 pay is $6,000. Remember, this is the most amount of money they can put in per year. But the number that I was referring to was this guideline single premium number. Remember, in the last one at $50,000, it was $19,000. But we took this death benefit to $75,000, and now it's $27,000, almost $28,000, which is why it's not erroring. So be mindful of that. So one last thing I do want to talk about before I end in this call for Mutual of Omaha is specifically in 90% of the cases, we are going to be doing IULE or Index Universal Life Express products, meaning IULE just means it's a simplified issue product. It does not require any blood work or any urine work. So if you look at the quoting for Mutual of Omaha, a client from ages 18 to 75 can get up to $300,000 worth of coverage, simplified issue, no blood work, no urine work. All that means to you is you submit an application, a free application. After 10 minutes, Mutual of Omaha is going to say yes or no, and that's it. Up to $300,000 worth of coverage. Now, if the client wants more than $300,000 of coverage, we call that a fully underwritten product. So if the client wants to get more, let's say they want $1 million of coverage, we have to do a slightly different product called Income Advantage. So in here, the IULE or the Index Universal Life Express product, that is what you're going to be writing in most cases. But if the client wants more than $300,000 of coverage, we do a Income Advantage product. And so basically, this will allow the client to do upwards to $65 million of coverage. So basically, anytime a client wants more than, let's say, $300,000 of coverage and they want to go with Mutual of Omaha, you definitely want to do the Income Advantage product. Now, I will tell you, Income Advantage means blood work, urine work, and typically these policies take months to get approved if the client even gets approved. So I typically stay away from fully underwritten products such as Income Advantage because they typically don't pay out, unfortunately, because it takes so long for the client to get approved. And by the time the client gets approved, they don't even want the policy anymore. So I typically stay away from Income Advantage products. But if you have a client who says, hey, I want $10 million of coverage, I want to fund this policy $100,000, every year for 10 years, those are rare instances. You have like high ticket clients, then yes, you definitely want to write an Income Advantage policy. But in most cases, I try to stay away from fully underwritten products. Simplified issue products are king, meaning the IULE product where there's no blood work or no urine work is king because you get an instantaneous decision, the client has instantaneous coverage, and you as the agent, you get paid immediately. So, but if you do have to write an Income Advantage or a fully underwritten product and the client wants more than $300,000 of coverage, you will be doing an Income Advantage. And you can create the illustrations the same way you do with NoSolve. So let's say, for example, the client wants $1 million of coverage. You can actually do this real quick. So first, I'm going to solve for minimum premium. Let's say $1 million for a 50-year-old. And then the minimum premium, this is basically going to calculate what's the lowest amount the client has to pay per month to get $1 million of coverage. And then once I know that, then I can do a no-solve illustration and say, hey, if you overfund this policy by an additional $200 every month, you're going to build better cash value. I'll show you what I mean here in a second. All right, cool. So 50-year-old male, $1 million of coverage. If you look at the annual premium, it's $14,000. And if we go into the illustration, open this up, the monthly premium for this client, the minimum premium specifically, is roughly $1,200 or $1,199.17. So this is how much the client is required to pay per month to keep this policy in force and keep it permanent coverage. But in most cases, I prefer the client overfund their policy. So we know that the minimum premium is $1,199. I'll tell my client, like, hey, client, I recommend, overfunding your policy to build better cash value. So if we go to no solve and we do face amount, keep it the same, but now we change the premium amount to, let's say, $1,300, hit calculate, and now it allows the client to overfund the policy, which is good. There's two other things I do want to show you guys before I end this illustration. And so I'm going to cancel this out. If we go back to the IULE, let's say, for example, the client wants to put in a lump sum payment. Let's say they say, hey, Dr. Goings, I want a $300,000 payment or $300,000 death benefit, and I want my monthly payments to be $200. But I also want to put in $10,000 up front right away. They'll ask me, is that, can I do that? And I'd say, yes, it's very easy. If you go to policy options and you go to pour in amount, this pour in amount is basically equivalent to like a lump sum amount. So in this scenario, the client wants to put in $10,000, but they only want to do it for 1 year, the very first year. You have to click on this little calendar right here, and you have to change the N to 1. So this now will show you that in year 1, the very first year, they're going to put in $10,000, and then after year 1, they're no longer going to be doing a lump sum payment. Let's say the client wanted to put in $10,000 over 5 years every year. You would just change this to 5. So in years 1 through 5, they're going to put $10,000 in as a lump sum payment, and then after year 5, they're not going to do a lump sum payment anymore. This is in addition to their monthly payments, by the way. Now, let's say the client says, hey, Dr. Goings, I actually want to do annual payments for 10 years at $10,000. And then after 10 years, I don't want to pay into my policy anymore. Can I do that? I'd say, yes, you can do that. If you change this premium amount to $10,000 and click on the calendar and change the N to 10. So from years 1 to 10, they're going to put in $10,000. And then after year 10, they're no longer funding the policy. It says 0 right here. And then if they're doing annual payments, you want to go to policy options. Remember, the premium mode is automatically defaulted at BSP for monthly payments. We want to change this to annual. So now the client will be putting in annual payment of $10,000 every year for 10 years. And then after year 10, they're good to go. If you kept this at BSP for monthly, it would show that the client was making $10,000 monthly payments for 10 years, which is roughly $120,000 annually. So that's basically the IUL in a nutshell for Mutual of Omaha in regards to the IULE as well as the income advantage. But you guys need to be focusing specifically just on the IULE and doing an easy solve and a no solve illustration if the client wants to overfund a certain policy. So yeah, that's it. If you guys have any questions, don't hesitate to reach out to us. Shoot us an email at support@bfinfluent, and we'll be more than happy to take care of you guys. I hope this helps.